if you've ever been on a cruise, the first thing you do, or one of the first things you do, is a lifeboat drill. So consider this your market volatility lifeboat drill. I am well aware of the recent volatility we've been seeing in the markets. We saw some really sharp downs, followed by some really sharp ups. Haven't erased all of the downs yet. But just a few thoughts I want to pass along regarding this volatility we've been experiencing. First, the downward volatility that we saw, the downturns in the markets, were the first significant correction, worthy of the term correction, in 4 years. It was 4 years ago, last August of 2011, when we last saw something of this nature. So this was really just overdue. I suspect, as we have nothing else to look to other than the fact that this will end and the upward movement of equity prices will ultimately resume, although I am compelled to say, as I always have to by regulations, that past performance is not indicative of the future. Now, I received one email regarding this volatility, and I was asked by this person, hey, how far do we let this go before we do something? A few things about that. Number one, I think we have done a lot and we're always doing something. Let me speak to some of that. First off, rule of thumb, any lump sums at any time that are going to be spent, large lump sums of your invested money, if they're going to be spent less than 3 years, that money really should not be invested. It should be out. It should be in cash, money market, CD, something like that, that you then can get your hands on, and it's not subject to market volatility. For the vast majority of our clients, they are saving it to accumulate for future income off of the money, or we have many people who are already retired and are drawing a stipend off of their money. In both situations, we've done work to put together a portfolio in advance, which is designed to manage volatility, and so we've done the work in advance in preparation for these times. In addition, the other thing that we do in response to these times is to rebalance. We are not a buy and hold and go sit down shop. We are a buy, hold, and rebalance whenever the mixes get off. So what we do at the end of every quarter is we sell off the asset category that's relatively high, and we buy into the asset category that is relatively low. If the quarter were to end right now, that would most likely be we would sell off the fixed income, which is higher. Those include bonds, and buy into the equities to reestablish the mix that we promise you. And then when we do that, what we've done with the portion that we rebalance is we have sold high and we have bought low. So we'll keep those disciplines going. I want to check my notes, see if there's anything else I wanted to say to you. The rebalancing discipline, and I guess in essence, along with the broad diversity of your portfolios, are designed to cushion your portfolio against volatility, while giving us the opportunity to continue to participate as markets improve and turn around. If you have any questions on this, by all means, please reach out to me. Thanks.